Good evening, ladies and gentlemen, and welcome along to this IC Markets webinar, how to pinpoint entry points with Fibonacci. And my name is Chloe, I'm with Trade with Precision, and I'll be with you over the next hour or so. Just want to give you an opportunity, first of all, before we get started, to have a look through this slide, which is the risk disclaimer slide. So have a read through, make sure you agree with everything therein, and then we can get started with the webinar. Okay, so that should be enough time to have had a quick look through that slide. Just want to take this opportunity as well to introduce myself a little bit better. My name is Chloe. As I said, I'm a trader based in London. I've been trading for 12 years. And I am a technical trader predominantly and a trend or momentum based trader. So I trade markets such as Forex, indices, commodities, cryptocurrencies, pretty much anything that moves in a trend-based fashion, I will be trading that. So I'd like to ask you all as well to just to check that you can see my screen okay and hear my voice okay. So if you wouldn't mind popping that feedback into the questions box for me. And while you're there looking for the questions box, just do bear in mind that, you know, it's best if we keep this session as interactive as possible. So if you do have any questions that you'd like to ask as we go through the session, then please feel free to drop those into the questions box. I'll do my best to answer as many questions I can in the time we have available. Thanks for the feedback, everyone. And with that, we will get started then with the agenda for this evening. We are going to be talking all about Fibonacci, so understanding the Fibonacci tools, and we're going to look at pinpointing buy and sell levels for trade entry, stop loss, and take profit levels. We're going to talk about incorporating Fibonacci tools into your trading habits. Now, I'd like to point out that that is important for me because I don't use Fibonacci as a strategy in itself, as a standalone indicator. I use Fibonacci to support my trading, to support the strategy that I already have in existence. So, you know, it really, for me, it's about finding a way to incorporate Fibonacci into what I already do in order to make it better for me. And to make it better, that could be more profitable, or it could be to increase my confidence in a trade, or to increase the probability of a trade going in the right direction, things like that. So anything we can do to improve each and every trade, it can only be a good thing. And then, of course, we are going to be spending most of our time on the IC Markets platform. I'll be using CTrader for this evening. And any questions, any markets you particularly want me to have a look at, then please do pop those in the questions box. And I'll show you a few kind of recent and relevant examples of where Fibonacci has and can come in useful. So let's get started then by going straight to the IC Markets platform. So bear with me just a moment while I get that up for you. Okay, so you should now have, let me just check, you should now have, yes you do, my platform up here with a few markets that I'm currently looking at. And I just want to point out, again, like I mentioned, I use Fibonacci as a tool in my toolbox towards my trading. It's not something that I use as a standalone thing, and therefore you can see that I do have some other things on my charts. The things that I have on my charts are, I've got some horizontal levels that I've drawn in here, and I also have some moving averages. I've got the 10 moving average in black, 20 in blue, 50 in red. I do often use the 200 moving average as well, although that isn't on at the moment. And really the most important thing for me is to find confluence between the various different indicators that I use. So using Fibonacci and looking to see if it overlaps with or forms an area of confluence with any of my other indicators or any of my other levels, such as the horizontal levels. And that gives me added confidence that that could potentially be a strong bounce point that I can trade from. But let's get started by just discussing the Fibonacci, I suppose, in its most basic form. Fibonacci was a mathematician, and the Fibonacci sequence is a sequence that can be seen in nature and throughout the world. It's a kind of strange one, but it does really work. You know, you can see in the Fibonacci ratio in, for example, sometimes in flower heads like sunflowers that have seeds, you can see how the seeds spiral out, and that goes according to the Fibonacci ratio. Sometimes snail shells, the way they spiral and expand as they get bigger towards the outside of the shell, that can relate to Fibonacci. And also even facial proportions. Experiments have been done where facial measurements between things like the eyes and the nose and the mouth, if they're in proportion according to Fibonacci percentages, then they are often deemed to be some of the most attractive features in a human being. So you know, Fibonacci is ubiquitous throughout the world, and it just so happens that traders use Fibonacci, and partly because it works, and partly by virtue of the fact that traders use Fibonacci, it works, if you see what I mean. So the fact that traders use it means that it can become a self-fulfilling prophecy. If enough traders are looking at a level, then that level can become real, because so many people are looking at that level and making a plan to execute an action at that level. For example, if you're looking to buy at a specific level, if everyone's looking to buy at that same level, then that can in itself move the markets, which then leads to further people buying and you know, a proper move starting. So these levels can be self-fulfilling. But basically, people use Fibonacci in trading because it does just give an extra layer of confidence to price moves. Now, I will point out that Fibonacci is only really useful in trending markets. Certainly Fibonacci retracements, which is the tool that we're going to be talking about today, only really useful in trending markets. So if you try to find, let me see if I can find an example of something that's not trending. Let's look at this here. This is euro dollar on the weekly time frame. This price action here in the middle of my chart is not trending price action. So, you know, yes, I can put a Fibonacci retracement tool on, say, for example, from the bottom here to this high. But it's not really going to tell me an awful lot, because really price is just trending at the moment. So that is something to avoid, is using Fibonacci in a range-bound market. But what we can do is use Fibonacci in a trending market. So let's have a look at the most recent price action we've got on euro dollar. As I said, this is the weekly time frame. Now, one of the things that we can use Fibonacci for is we can use it to measure extensions and retracements and actually work out where a likely point in a trend is price likely to retrace to. So as we all know, I'm not sure, and correct me if I'm wrong, but I don't think any of you listeners today are complete beginner traders, so you probably will know about price action and trends. Again, correct me if I'm wrong, and if anyone wants me to explain anything further, then I'm more than happy to do so. But in a trend, what we're looking for is we're looking for price to be moving overall in one particular direction, but we don't expect price to move consistently all the same direction all at once. We look for what actually happens with the structure of price, which is a move in the direction of the trend and then a pullback, a move in the direction of the trend and then a pullback, a move in the direction of a trend and then a pullback. The moves in the direction of the trend tend to be longer and further than the pullbacks, and that gives us a series of lower highs and lower lows. Now, in a trend trading strategy, what we're looking for really, we've perhaps analysed the market, and we've analysed that there is a downtrend. We want to be short in this market. We want to take trades to the downside. Perhaps we have a fundamental bias to the downside as well. I'm not going to discuss fundamentals in this particular webinar, but for whatever reason, we want to trade short in this. But if we were to just sell, you know, just turn up into a market and think that's going down, I want to sell. For example, we could just sell where price currently is right now, but there's nothing stopping price from then starting a pullback, and we could in fact lose money if we get stopped out of that particular trade. So as a trend trader, it is our job to find trends, but it is then our job to find the best price, the best point at which we can enter in order to make money from that trending market. And that's why it's so important to analyze the highs and lows in price action. So ideally, in a downtrend, we want to be waiting for these pullbacks to happen, because we want to be getting into the market at the highest price, ready for the next move in the direction of the trend. And once that move has gone, we then want to wait for another pullback. We want to be getting in at the highest price of that move, ready for price to move away again. So in a downtrend, we always want to actually be getting in at the highs of price, ready for price to move lower, and so that we can make profits from that price move lower. So what we need is a way of working out where the high of price is. And there are a few ways that we can do that. And for that purpose, I have the moving averages on here, because price can tend to return to an area of equilibrium. And certainly the area between the 10 and 20 moving averages can tend to be an area of equilibrium that price can tend to return to before it moves off in the correct direction again. So that's why I have those on my chart. It's not you know, price hits the 20 moving average and I press sell. Definitely not that, but it just gives me an idea of a zone, an area on the chart that price might pull back to before it moves off in the right direction again. Now, that combined with another very important factor for me, which is horizontal levels of support and resistance. So any trade that looks like it might be setting up in and around this area between the 10 and 20 moving averages, coinciding with one of my horizontal levels of support and resistance. And again, this webinar is not long enough for me to really go through an instructional webinar of how to draw levels of horizontal support and resistance. Hopefully you guys are all familiar with those anyway. But I will have drawn, based on my monthly and weekly and also daily time frame, various levels of support and resistance that are important to me in my trading. So you can just see a few of those here. I've got strong levels of support and resistance based on the monthly chart, based on the weekly chart also. So if there is a point in time where price is trending and there is a pullback that meets one of those levels of support and resistance, then that gives me extra ammunition in my toolbox for extra confidence that that could be a strong level for a bounce, and therefore a strong level for me to enter a trade potentially. Now, Fibonacci is another one of those tools that can be used in order to give us confidence that this potentially could be an area that is worth getting into in the market. So let's have a look at the Fibonacci on this euro-dollar market. Fibonacci tool you can access in this toolbar on the side. Obviously, it depends what platform you are using. If you're using the MT4 or MT5 platform, then that will be slightly different. But for CTrader, there's a little toolbar at the side that has commonly used tools that we can draw onto the charts, including things like trend lines and horizontal lines as well. So if we hover over Fibonacci, we can come to the top one, which is Fibonacci retracement. I'm just going to click on Fibonacci retracement, and that will then mean next time I click on the chart, I will be placing the Fibonacci tool onto the chart. Now, the Fibonacci retracement tool, in a downtrend, we start at the high. So I'm going to pretend that this future price action hasn't happened yet. I'm going to start at this high here. So in the downtrend, we start at the high, pull the tool down to the low of that particular swing, which is down here, drop the tool there. So I've clicked at the top, I've dragged my mouse down to the bottom, and I've let go of the mouse at the bottom. That has drawn my Fibonacci tool, and it has these levels on. Now, let's zoom into this slightly. These levels, you can actually amend which levels you want to see on your chart. So if we come to this settings icon here, once we've selected our Fibonacci that we've just drawn on the chart, these are all the possible levels, and you can actually write in your own levels if you like. But the important Fibonacci levels, obviously we have the 0 and the 100 to show us where the Fibonacci is starting and finishing. At 23.6, 38.2, 61.8, those I would say, in fact 38.2 and 61.8 are the most important levels for me. We also have 23.6 and 78.6, also Fibonacci levels. And people very often have the 50% level on as well. Now, 50% is not a Fibonacci number, but it's a very useful tool in trading to know where the 50% retracement of a move is, because it is a very frequently reacted upon level. So those are the levels that I have on my chart here, and you can see that it's drawn these lines in black. 100% retracement would be if price moved all the way up to the back to the top where it started from up here, and then we have 78.6, 61.8, 50, 38.2, 23.6. So those are the important Fibonacci levels that we've drawn on here, and what we can see is this move from the top to the bottom, that pullback comes up to the 38.2 level. So that's a pullback to the 38.2 level, which is a Fibonacci number. Now that in itself wouldn't necessarily get me into a trade, but the fact that that 38.2 level coincides with this area in and around the 10 and 20 moving averages gives me a little bit of added confidence that a pullback has happened, and this could be an area that the pullback might end, and therefore give me a potential entry area into the trade. Now, if you want to trade on the weekly chart, that's absolutely fine and of course possible. What I would generally tend to do in that case is I would look for, in that area around the 38.2 Fibonacci level and the moving averages, I would be looking for signs that the pullback has ended and the move to the downside is about to begin again. So the pullback, we can see these green bullish candlesticks. I would be looking for a bearish candlestick. Once I see that, which I do see here, I would place an entry at the bottom of the candlestick with my stop loss potentially at the top of the candlestick. One other thing that can be done with Fibonacci, let's just zoom in a little bit here, is, and this is not something that I do often with my particular strategy, but it can be an option. If price has pulled back to the 38.2% retracement and you're looking for a more accurate entry here, then what you can do is simply place a stop loss behind the next Fibonacci level up. So in this example, it would be behind the 50% Fibonacci level, and that should give enough space that, bearing in mind what we want for a stop loss is we want the trade to be taken out if we are wrong. If I'm wrong that the price is retracing to the 38.2 level, then what is going to prove me wrong? Well, a further retracement up to the 50% level would prove me wrong about the 38.2, and I would therefore want to be out of that trade until I see further evidence that price is going to move to the downside. So let me just catch up with the questions. I can see a couple of you are asking questions. So in answer, hi Ben. Ben has asked about the periods of my moving averages that I'm using. So I'm using exponential moving averages, and the black one at the bottom is the 10 moving average. The blue one is the 20 moving average. The red one is the 50 moving average, and they are exponential moving averages. Now, because I don't use moving averages for exact buy and sell points, it's not hugely important whether they are simple or exponential. Either of those options can work. I prefer exponential moving averages. It just reacts more closely to the most recent price. It's weighted towards the most recent price, and I prefer using exponential moving averages, but you can use either. I hope that answers your questions there. And so what we can also do is we can be looking at price action here on the weekly time frame. Now, not many retail traders would trade on the weekly time frame because you have to have a pretty large account to make profits from these big moves on the weekly time frame with wide stop losses like this. So what you can also do, once you've drawn your Fibonacci on this time frame, you can go down to a lower time frame. So let's go down to the daily time frame and go up to where we've drawn that Fibonacci. And it can also be possible to fine-tune an entry. So I've drawn the Fibonacci here from the top of that move to the bottom on the weekly time frame. How can I get a finer entry on the daily time frame based on this Fibonacci retracement? Well, here is the 38.2 level that price has retraced to, and as you can see, it doesn't actually coincide with my moving averages on the daily time frame. And not only that, but price is not actually trending at this current time on the daily time frame, because I've got a high here and this is a higher high, and for a downtrend to be intact, I need lower highs and lower lows. This is a higher high. So what do I need to see in order to trade? Well, I've got my eye on this level because it's a Fibonacci level. I can now see moving forward that price has reacted from that. And just here is the beginnings of the downtrend on the daily time frame here. So I've got a lower high here. So I've got my 38.2% Fibonacci level on the weekly time frame, and I'm looking for a more accurate entry on a lower time frame. So I'm looking for the point at which the trend is going to resume on the lower time frame. So I've got this lower high on this daily time frame. That gives me the trend. I also then have this low in place here. As soon as this low is broken, that gives me a downtrend. In theory, one could actually enter as soon as this low is broken with a stop loss above the Fibonacci level. That could be one option. However, I prefer the option of waiting for the next potential setup on the daily time frame, which would be a bounce in the area in and around the 10 and 20 moving averages, and I'd be looking for a reasonably small sized bearish candle in this area. So this candle here or this one here would both be appropriate for that particular trade. And if I were to do that, I would simply have an entry at the bottom of the candle with a stop loss at the top. And you can see how you can actually make just as much profit, if not more profit. And that goes down to a 2-to-1 reward to risk before pulling back, as if we were to have traded on the weekly time frame, where our stop loss would have been all the way up here and our entry somewhere down here. So we would have needed price to move a lot further to make that 2-to-1 reward to risk profit. Let me just catch up on the questions again. Okay, I think I'm up to date on the questions. Fantastic. So going back to the weekly time frame then, let's have a look. I'll just erase this one because it can get confusing if we leave too much on the charts. Let's have a look at the next move then. So from the high of the move here down to this low here, and where has this retracement come to? Well, it's come again to that 38.2% retracement level, and again that coincides with price being within these the 10 and 20 moving averages here. So we can see that quite often in a trend, price can tend to retrace to the same Fibonacci level over and over again, which can give us even more confidence in the continuation of that trend potentially. So let's go from the high up here down to the low. Now this price has really kind of sat at this 38.2% level, and that's really where price has bounced from, but it has actually come up all the way up to the 50% level. And this is another thing that I would say is really a retracement anywhere between around the 38.2% level and the 61.8% level is an appropriate retracement for a smoothly trending market. So in a very strongly trending market, you can sometimes get a retracement to the 23.6 level as well, but I would say in general, people tend to use the 38.2% level, and any area between there and the 61.8% level would be an appropriate retracement to then trade as a continuation of a trend. Once price starts retracing as far as the 78.6% level, that is a very deep retracement, and that can indicate, yes, price can move down from there, but it can often be a precursor to a change of trend. It can often mean once price has retraced, let me find my pencil here, if price were to have retraced all the way up to the 78.6% level, the probability of a continuation of that trend, i.e. price coming all the way down and forming a new lower low, is less. And actually what is more likely to happen is if price pulls back to the 78.6% level, is there's more likely to be another move down, but then a higher low forming that could potentially then lead to either range or a change in trend. So really the 61.8% level is the furthest level that trend traders tend to use as a retracement level for trading. So this particular example, it's retraced, it's pulled back to the 50% level. The next example, let's just have another look down here. So we're going to go from this high here down to the bottom, and that one has pulled up to the 50% level as well. And again, it coincides nicely with the area between the 10 and 20 moving averages here. The next one also, so we'll go from this high down to here, and that one has retraced up to the 50% level as well. But you can see that's really just a spike, that's just a tail on one of these candles, and the majority of the price action settles at this 38.2% level. Let's go down to the daily time frame and actually see what's going on here. So with the daily time frame, we can see there's the top of the move, the bottom of the move. We can see the majority of price action has come to the 38.2% level. Now, what I would actually do here, because this area here is within, it's retraced to the 38.2% Fibonacci level. It's in a nice downtrend on the daily time frame, and I have got here a reasonably small sized bearish candle. So I might well have taken that trade. I would have been entered into the trade because my entry would be beneath the candle my stop loss would be above the high of the candle, and I actually would have been stopped out of that trade once price came up here. So that's an example of where this didn't fulfill my needs, really. It didn't help me, but that's not because of the Fibonacci. That is just one of those examples where I took a losing trade, and no trader can win 100% of their trades. It's impossible. So there will always be a losing trade, and that is part and parcel of trading. What I can then see is that price retraced further to the 50% level. It then came down, made a lower high, and continued down. So while I may not have been able to pick this up on a daily time frame, there is still the option that I could, and I'm sure a lot of you are also interested in trading on the lower time frames. So let's have a look down to, let's say, the 4-hourly time frame here. So this is my lower high that I pointed out on the daily time frame, and perhaps we can use the Fibonacci retracement tool again on this 4-hourly time frame. Let's go from this high down to this low, and price is now pulled back to the 23.6 level, just past the 23.76 level, and that coincides with these moving averages. So that could be a potential area to look out for a continuation of that trend, and that is exactly what happened. What we can then do moving forward for what is happening right now is we can use this Fibonacci retracement tool again. So from this high down to the bottom, and we can see price has pulled up to the 38.2% level. So we can see there that that's a suitable Fibonacci level. If the trend is going to continue, then that would be a suitable place to anticipate that continuation from. So I hope you're finding this helpful. It's Fibonacci is not a tool that I use as a standalone thing. It's something that I use to bring me an area of confluence where that Fibonacci level might coincide with a horizontal level or a moving average that I use for my trading strategy. Let's have a look at some other markets as well. So dollar yen right now, this is a market that could potentially dollar yen, and in fact all of the yen crosses, they can tend to trend quite nicely when they do trend, and we've had quite a few months of really strongly trending price action on dollar yen. It's been less reliable of late, so the last the last kind of couple of months really have been a lot more rangy, and we've seen a deeper pullback here. But at the moment, what we do see, here's the low, we've got a higher low, here's a high, and we have a higher high. So that is potentially the beginnings of a renewed uptrend. After having seen this move down and all of this kind of messiness around here, we've got the beginnings potentially of an uptrend. So we can start to overlay the Fibonacci just to see what might be a suitable area for price to retrace to in order to find a trading entry. So I'm going to go from the bottom of this move here to the top. And so far, price has pulled back to the 23.6, but it does actually show that the 38.2 level comes down to around this 10 and 20 moving average buy zone, this zone of equilibrium here. So, it's all well and good looking at in the past, but what we actually want to try and do with Fibonacci is work out what might happen in the future. So for me, what I would ideally be looking for in this particular case is I would be looking for price to pull back down to my 38.2 level or thereabouts. And talking about areas of confluence, what I really like about this is, if I get my horizontal level tool, this previous high here, which actually coincides with This previous high here coincides also with this previous low, so that is a level of potential support become resistance, and that coincides quite nicely with my 38.2% retracement level and this bundle of moving averages here. So that makes it a very attractive area to look for a pullback to, because once price has pulled back, it gives the confluence between these factors gives a strong bounce area, which potentially could then lend a higher probability that the trend could continue, and therefore if I'm trading in the direction of the trend at that point, there's a higher probability that my trade could be successful. So what I would be looking for in this case, I've just used the Fibonacci as an area of confluence, but I would be looking for price to pull back down into this area, and then I would be looking at the individual candlesticks. I'd be expecting red candlesticks, bearish candlesticks pulling down into this area, and then when I see a reasonably small sized bullish candlestick, and that could look like this, a rejection candle like this, or it could simply look like a green candlestick, something like that one there. Anything like that, anything like that. That's what I would be looking for, and then I would be looking to place an order at the top with a stop loss at the bottom of the candle, and then if price does continue in the direction of the trend, then my order will be triggered, I'll be entered into the trade, and hopefully off price goes. Of course, there is always the possibility to go down further time frames, so I'll go down to the 4-hourly time frame just here. And we can see on the 4-hourly time frame, there's the daily Fibonacci that I drew in, and it shows that actually price is settling at this 23.6 level. Now, I'm not able to trade that using my trend flow strategy because there is no agreement of my moving averages at this point in time. So the 10 moving averages dipped below the 20, and I would need that to be above in order to confirm my trend. So this pullback is a little bit stagnant now on the 4-hourly time frame. I would need to see price move away, give me a higher high, then a pullback, and then I'd be happy to trade that based on price having reversed at this 23.6% level. But if price pulls down to the 38.2, then it's back up to the daily time frame, because that looks much nicer as a retracement on the daily time frame there. Let's have a look at Euro Swiss as an example as well of Fibonacci. Basically, any trending market, you can just have a go at putting the Fibonacci on and seeing this here is a 50% retracement. That also just about coincides with that area between the 10 and 20 moving averages. But if we then look, let's remove that one, and if we then look at the next swing, so from this high here down to this high here, that is actually a 78.6% retracement. So that would be too far for me to use that as a potential Fibonacci entry, or use the Fibonacci as support for my entry, because that then starts to suggest that that retracement could be too deep for a trend continuation. In this particular case, it actually did result in a trend continuation, but for that, I would go down to a lower time frame, and I would be looking for that trend to continue on a lower time frame down here. Kiwi dollar on the daily time frame. This is another example of where we can use this for trend continuation over here. So we've got a high up here, the high up here, pulling it down to the low. That is, just zoom in a little bit so you can hopefully see that a little bit more clearly. So that is a pullback to the 23.6% level and in the area of the 10 and 20 moving averages. I did say that the most common area to look for retracements is between the 38.2% and 61.8%, but in a very strongly trending market, price can retrace, you know, not very much at all. You can get very shallow retracements. So that's why the 23.6% level can still be useful for those shallow retracements. So again here, this gives confluence between the moving average area and the Fibonacci, the 23.6 Fibonacci level. And so again, I'd be looking for my bearish candlestick in this area, and I would be looking to place an entry at the bottom of that candle with a stop loss at the top of that candle. And I would be looking to target probably around 3 to 1 for that trade. And that doesn't mean I have to take the whole target at 3 to 1. Quite often, if I'm trading conservatively, I will scale out of the position progressively and, for example, take a third of the position off at 1 to 1, a third of the position off at 2 to 1, a third of the position finally off at 3 to 1. That's if you want to be conservative and take profits along the way. Just erase that, and then let's have another look. Erase that one as well. In fact, actually, what we can do, I will put that one back on just to see if it works out here. Let's go down a time frame down to the 4-hour time frame. Over here. So this is a really nice example of using the Fibonacci to give confidence of trend continuation, but actually looking for potential entries on a lower time frame. So what we can do here on the 4-hourly time frame, we've used the Fibonacci on the daily time frame, and we've now seen this area of the 23.6, and that was in the area of those moving averages on the daily time frame as well. But perhaps we can fine tune our entry on the 4-hourly. If this is going to be a trend continuation, we could either wait to see the price action on the 4-hourly, and this is a little bit trickier to see, I suppose, but just here we do have a lower high on the 4-hourly time frame, and that is coinciding with that area on the daily time frame that matched with the 23.6 retracement and the moving averages there. So on the 4-hourly time frame, perhaps we could actually put an entry at the lows there with a stop at the highs, or alternatively, if you feel that that's a little bit too early or a little bit too risky, you could still go with the trend flow strategy of waiting for the pullback into the area between the 10 and 20 or around the 10 and 20 moving averages, waiting for that bearish candle and placing a stop loss at the high, entry at the low, and look how much more reward to risk you can get from that potentially, because it's a much tighter distance between the entry and the stop loss. So that subsequent move can give you quite a decent reward to risk potentially. So looking at that, you know, you could easily get a 4 to 1 reward to risk just in that small period of time there as price moves. So that's another way to use it. You can use it to look for likely areas of retracement on the daily time frame, and then just go down to a lower time frame to really fine tune that entry. Let's go back up to the daily and just see what happens for this one here. So going from the high up here down to the lows, and we can see again that has come now to the 38.2% retracement area. And again, we could go down to the 4-hourly time frame. We could either use that as an entry in itself, or we could go down to the 4-hourly time frame to see if we can fine tune the entry at all over here. So on this 4-hourly time frame. Here's that Fibonacci level retracement here, and then what we've actually got is we've got price coming down and forming a bit of a horizontal level of support. This horizontal level of support, really we would want to see that broken before we start to trade. So again, we would be looking around this area here at price breaking out, and potentially we could trade a breakout strategy trade here. So entry beneath the lows, beneath that horizontal level, with a stop loss above the highs up here. So that could potentially be an option as well, again based on that Fibonacci. It's not the cleanest, this one, I must admit, so that's probably not a 4-hourly trade that I would have taken myself. It didn't quite work out as I would have liked. Quick look at the questions. Can you use Fibonacci on the hourly time frame? Absolutely, yes. You can really use Fibonacci on any time frame. Depending on which time frame you're trading. I do actually frequently trade the hourly time frame. It's basically a case of finding trending price action and using Fibonacci once you've found trending price action. So if we look at this bit of trend that we were looking at on the hourly time frame, for example, over here, for example, is a nice trend on the hourly time frame, and you can exactly do that. Take a look at, for example, here, from the top of this move here to the bottom, and then you've got your Fibonacci levels. So you would potentially be looking for price to pull back into the moving averages, and that correlates quite nicely with the 23.6% level on this particular occasion. So yes, absolutely, you can use Fibonacci on whichever time frame you need to, really, whichever time frame you're trading, in order to give yourself confidence that there is going to be a trend continuation. Let's have a look and see if there's any more decent trend here. It's been quite rangy over this period of time. This bit here, for example, from the low up to the high, and we can then see that price has pulled back around this Fibonacci level. I've confused things by not deleting that last one. Let's go and delete a few things. Okay, questions. So if I'm going to enter on the H1, I will draw the Fibonacci on the H4. Not necessarily. I'm kind of going through two ways of doing it here. So I have been talking a lot about drawing Fibonacci on the higher time frames and then going down to a lower time frame in order to trade it. And that is one way of doing it. But you can also simply use the Fibonacci on the time frame that you are trading. So for example, let's go back to dollar yen here. So for example, I could quite easily trade this on the daily time frame. I drew that Fibonacci from the bottom to the top, and all I need to do is sit and wait. And if price pulls back down to this area, which is the coincidence of the 38.2% Fibonacci level, this horizontal level where this previous high falls, and falls in or around the 10 and 20 moving averages, then all I need to do is look for my bullish candle, and away I go with a trade. So if you want to use Fibonacci on the hourly time frame, you can plot it on the 4-hourly and then drill down to the hourly to find an entry, or you can simply plot it on the hourly time frame. Either way is I know people who do either of those things. Okay, let me just catch up with the questions. Okay, so will a good confluence be using stochastic RSI overbought, oversold along with the Fibonacci? Now, I can only answer this from my own point of view. I do not use, you can see I do have RSI on my charts. I don't use it for overbought and oversold. I use MACD and RSI as momentum indicators for convergence and divergence. I don't use overbought and oversold. So I can't actually tell you the answer to that question based on my own personal experience. But if you have a strategy that you are already trading, and presumably some of you do, if you have a strategy that you're already trading successfully and you're looking for something to improve it, then absolutely, why not try Fibonacci and see if it does improve it? And the only way you will discover that is by trading and documenting every single trade and seeing how that adding Fibonacci has improved your performance over the course of a month, over the course of 3 months. But absolutely, I do suggest if you do have a strategy where you successfully use stochastic or RSI or overbought or oversold as your entry trigger or as part of your entry criteria, then absolutely adding Fibonacci could help that. And what you need to do is you need to go away, add the Fibonacci, trade it, monitor your results, journal everything, and then come back after, I would say, at least 3 months of trading that same way and compare that to your previous results to see if you've actually made an improvement in your strategy that way. Okay, could I do a session for existing, not running trades in the right direction? Could you clarify that, Dave, for me? Do you mean if you're in a losing trade, what would you do then? Not running trades in the right direction. I assume you mean if you're in a losing trade, what would you do then? And if I have interpreted that right, then if you're in a losing trade that's not going in the right direction, every single time you enter a trade, there should be a reason for entering that trade. Now, with my trend-based trading, I am trading highs and lows in the markets. I'm trading trend, and I'm looking for a higher high, then I'm looking for my higher low, and at the higher low, I'm going to get into the market. So let's just, for argument's sake, say that the higher low forms here at the 38.2% level. Now I'm going to get into the market, I'm going to buy this in anticipation that price is going to continue trending. And price continuing to trend means I have to continue to see higher lows and higher highs. So if I'm correct that this is the higher low, and if I'm correct that price is going to continue trending, then I need price to move up here and give me a higher high. Okay, and that means that if at this point here I get a bullish candle, let's just say it's a candle that looks a bit like that, I'm going to put my stop loss beneath and my entry at the top. That means that if this is the low, then price is going to continue moving upwards and I'll be entered into the trade. And that should then, if my belief of the fact that this market is trending, that should then also give me a higher high. Now, that is my reason for entering this trade. When do I want to not be in this trade anymore if it goes against me? When my reason for entering becomes wrong. So if my reason for entering is that I believe that this is the low, this is the higher low, then I become wrong if price comes down below my stop loss here. Then I was wrong about that. It wasn't the low and price is coming further down. So I just want to be out of that trade. And that can be based on Fibonacci. It doesn't have to be based. I generally tend to base that on candlesticks. I generally will enter a trade above a candlestick with a stop loss below, or enter a trade below a candlestick with a stop loss above if I'm trading the opposite direction. I hope that makes sense. So if you're in a trade and the trade is going against you, you should already have in place a stop loss, which is in an area that means that your reason for entering the trade was wrong. Does that make sense? So you should never be in a trade that's going against you and thinking, oh my goodness, I'm really worried about this. What am I going to do? Because you should already know where you're getting into the trade and where you're getting out of the trade, whether it's getting out for a profit or getting out for a loss. You should already know that, and it should be based on your belief of the market. If I'm going to get into this trade to the upside, it's because I believe the market is going up from here. Therefore, if the market goes down further, I was wrong. I just got it wrong, plain and simple, and I need to be out of that trade. All right, so let me just briefly go back to the presentation. Just to give you a little final screen here with contact details. So if you do have any questions, any problems, they've got a fantastic customer service team here for you. There's an email address there that you can contact. There's also a telephone number that you can contact with any of your questions. They have the usual socials, Twitter, Instagram, Facebook, and please do, if you've enjoyed this webinar, please do make sure you register for more. We do several webinars per week with IC Markets, so make sure you make the most of those, and I do hope to speak to you at some point in the not too distant future at another one of these webinars. Cheers everyone, have a fantastic evening.